recovery mode. Over the past 7 sessions, foreign investors have bought aggressively in the Indian markets with close to $3 billion coming into Indian equities alone. What is the prognosis for global growth? What does the US-China standoff mean for a country like India? What will be the direction of foreign flows going forward? And how does India sit in the eyes of foreign investors in this environment? I have with me a very important global voice, global strategist of Macquarie, Viktor Shvets, joins us from New York. Thank you so much, Viktor, for joining me on this discussion today.
Thank you for having me.
Viktor, let me first start by asking you a question that seems to be on every investor's mind in India right now. Over the last 7 sessions, we've seen about $3 billion in inflows into Indian equities. How do you see this shift? Is this a shift or is this just a tactical trade that is playing out? How do you see this?
I think what we've seen in the previous 9 months or so, when investors were aggressively selling India, was repricing of India. In other words, expectation of 8% GDP growth rates, in my view, was never achievable to begin with. The appropriate or the normal growth rates for India, in my view, has always been around 6%. Now, that implies about 9 to 10% in nominal terms. So what the market needed to do is to adjust the growth expectations, which is what they've done. Secondly, you need to adjust the earnings per share expectations, which is still in the process of doing. And thirdly, you need to adjust the multiples, which is what was occurring as well. So to me, India has one of the best long-term sustainable growth model. As I said, not at 8%, but nevertheless, one of the fastest sustainable growth rates globally. India also have a tremendous structural story. And that's part of the reason why in the past, India, certainly over the last 10, 15 years, India was treated somewhat different to the rest of the emerging market universe. And so what we're seeing is that people having repriced some growth expectations are coming back to India as one of the best positioned longer-term emerging markets.
So you're saying that this money is really coming from foreign investors who were just sitting on the sidelines because India valuations were high?
Well, what you have seen as well, it's not just India. There was an outflow out of the United States into Europe, and there was a significant inflows also into China. So part of the reason why India started to re-rate again is this perception that US exceptionalism no longer applies, certainly not to the same extent as it did over the previous 10 or 15 years. And so investors are also relocating to other markets, but they're quite selective. So in other words, they're not really relocating into cyclical markets. So there is not much relocation into places like Malaysia or Indonesia. But what they're doing is relocating into structurally better looking stories. So if you think of Europe, Europe for the first time in at least 20 years might have a possibility of growing a little bit faster, allocation of capital might be a little bit better, and return on equity might be improving. If you think of China, the question is whether it was over-penalized for the nature of China and Chinese economy. How different is actually China today from the United States? Now, that question would not have been asked 6 or 7 months ago, but it is being asked now. And in the case of India, again, a strong structural story, which needed to grow into growth, so to speak. You needed to reflect it. So India is not the only one who benefited from that. There is also a global shift away from believing that US is truly exceptional.
Will it be fair to now say that, somewhere we are going to see we can see this as an inflection point? The worst of the FII selling is now coming to an end?
Well, if you think of India specifically, I think we're already gone through the period of sell down and adjustment of GDP growth rates, adjustment of structural reform expectations, adjustment for multiples, not quite adjustment of earnings per share. Earnings per share in India are always too robust. And today there still are. If you are looking at nominal GDP growth rates of about 10%, it's incredibly hard to justify why earnings per share growth rate should be 17, 18%, for example. So there is still certain things to be done. But as I said, a lot of adjustment already occurred over the last 6 to 9 months. Now, going forward, one of the key variables clearly will be how investors will perceive US and extent to which this perception of lack of uniqueness of the United States has been overdone, perhaps over the last months or two, and extent to which people actually return to US. So there will be other shifts occurring, but I think in terms of India, a bulk of the adjustment has already been done.
Okay. And what do you expect? Will money generally move out of US equities now? Is that your sense?
That's what's been happening for the last 2 months, and not surprisingly, because what we're seeing is significant tectonic shifts occurring. It's a revolutionary change. Most people are focusing on the trade war. Trade war is not about trade. It's about remaking America. It's about remaking America socially, culturally, economically. And the only way you can remake America is by remaking the world. And so the perception is that this remake will make US less exceptional, higher risk premium. Risk premium on US assets have already gone up compared to what they were over the last several years, in fact, over the last decade or longer. And so that outflow continues. Now, the question is, how long do you keep going on the same path? Because at the end of the day, U.S. is still structurally very sound economy. U.S. still has labor, capital, and gross multi-factor productivity. It still has a tremendous geopolitical position. It has ample amount of resources and commodities. So extent to which we actually continue to derate U.S. As an exceptional economy will really depend on U.S. policies. And as I said, it's not just goods trade. It's spilling over into services. It's spilling over into balkanization of capital. It's spilling over into U.S. institutional pillars and therefore degree of trust. So have we seen outflows out of the United States? Absolutely. How far is it going to go? It's really very much depends how far United States is willing to go in order to change itself and as a result, change the world.
Viktor, but do you still believe that Trump tariff is a risk? Because on most of the announcements that he made on April 2nd, he's pretty much gone back except China. And I don't know, what is your view on US versus China in terms of tariff? And since a lot of it has gone back, of course, it seems like he's said it's a pause for 90 days, but the market seems to be expecting that it might normalize. In which case, do we still go with the thesis that there is a serious shift indeed?
Well, the thing is, Trump administration constantly sending conflicting signals. And the reason they're conflicting is that Trump, as well as the Republican Party, is basically channeling grievances, popular grievances across a range of areas and people and groups. Those grievances are not mutually compatible. So one part of Republican movement is clearly technology and technological titans, people like Elon Musk, people like Mark Andreessen, Peter Thiel. Those people are very much globalist. They believe in technology. They don't believe in tariffs. They believe that technology ultimately will reduce marginal and average cost of everything down to zero. They are against unions. They're against the government putting regulatory restrictions on what technology can do, how much technology can propagate, but they're also in favor, for example, of universal basic income as a way of supporting the economy. Now, the second group of people are much more nationalist. They are much more parochial. Example of that will be Vice President J.D. Vance. It will be Stephen Bannon, Stephen Miller. These people are very different. They actually want to return America to 1950s and 1960s. They want U.S. to save, invest, rather than consume. They want to have traditional values. They want to almost completely close down immigration, legal and illegal, but they support trade unions. They want to have trade unions to have a stronger power. They support a lot of social spending. And the third area of Republicans, and Scott Bassett is one of them, is more traditional Reagan Republicans who concern more about government spending and government debt. They want private sector to take a leading role rather than the public sector, and more traditional conservative values. And so all of these things are in contradictions. So when people ask, is America in favor of strong US dollar or weak US dollar, the answer is both. Is America in favor of free market or protectionism? Both. Is America in favor of unions or against trade unions? The answer is both. And so what you're seeing, therefore, and that's what you're discussing, is that we constantly get contradictory signals. And the reason for that is that there is no consistency. There is no consistency in the grievances because Donald Trump represents a huge array of popular grievances across the United States that are not the same. They don't have the same ideology. But there is an objective. And ultimately, the objective is, as I said, to remake United States socially, culturally, economically. The only way you can do it, you have to remake the world. How do you remake the world? You use the structural strengths of the United States in order to force other countries to change how they spend, how they save, how they invest. And you also create a very strong unitary form of presidential government without any checks and balances, with not much of a check and balances from a judicial branch, from legislative branch. And so when people say, are we normalizing trade? Is it already behind us? Well, not really. As current account deficits go up and down, there will be whiplashes. There will be more tariffs coming in this product, in the other product, in this industry against this country. I don't think there is such thing as agreements. I don't believe there will be such thing as deals. But having said that, capital markets are a real brake on what Donald Trump and the United States can do. And so early in the year, I assumed that U.S. tariffs will go up from 3% to maybe 7, 8%. That would not have been terribly disruptive or inflationary or retarding growth in any meaningful way. If you think of Liberation Day and stack up all the tariffs, that look like well over 30%. That's a disaster. That's complete unscrambling of the entire world, both economically and geopolitically. Where are we going to end up? My view has always been somewhere around, certainly in the last 2 months, been somewhere around 15 to 20%. We're probably going to end up as tariffs. Now, at around 15 to 20, it's still inflationary, it's still disruptive, but certainly it doesn't unscramble the whole world. Now, China-US relationship is special in a sense that there is a significant geopolitical angle. So when people say, are we going to go back to normality with China? No. U.S.-China relationship were not normal since late Obama administration, continued to Trump 1.0, continued through Biden, continues through Trump 2.0, and it will continue beyond that. So the desire to disentangle or grind China out as much as possible out of the system will continue. Will there be some beneficiaries of that? Yes, there will be. But those beneficiaries also have to be careful. They can't just become transshipment areas for China, because there will be a whiplash from the United States, as you have seen in places like Mexico, Vietnam, Malaysia. There will be a whiplash. So they have to be careful. They have to actually add value.
Fair enough. So one point you said that, tariffs are definitely going higher. I mean, from 3%, you're indicating 10 to 15%, which will be inflationary. In which case, where do you expect interest rates to be for the rest of the year?
Well, that's part of the reason why Federal Reserve and all other central banks are data dependent. Data dependent basically means that they have no idea what to do. They are completely backward looking. Now, you're only backward looking if you don't know where the neutral rates are, you don't know what risk premium is going to be, because we're focused so far on goods. So let's assume US does go to 50 to 20%. Let's say other countries go to a certain level. In other words, the global tariffs globally overall increasing to the highest level since we've seen probably in 1930s. But it goes beyond that because we're also disentangling the geopolitics. So there is no question that it will be almost impossible to heal the rift between Canada and the United States. There will be no return to normal between Europe and the United States. And there are many other fractures that occurred on a global basis between what I describe as the Sinosphere, China and its associates, United States, and what used to be called Western allies in various forms. Now, if the United States no longer offering public goods on a global basis, because remember, since 1945 until about 10 years ago, the US was providing willingly public goods, safety, security, shipping, ability to maintain global order. If the United States no longer willing or able to provide that, then you've got chaos. You've got everyone against everyone. Now, if you do that, then inevitably it's not just about goods. It becomes about other things too. We already seen in services. For example, Jamie Dimon of JP Morgan was highlighting that JP Morgan is losing deals now in Europe because those deals now go to European banks, not to the US banks. Would you have a backlash against US technology companies and technology exports, including software? I think the answer is yes. You're going to see that. You're seeing China now reducing the number of Hollywood movies that they allow into the countries. So it's not just about the goods, it will spill over into services. If you start deglobalizing more goods and services, inevitably you start deglobalizing capital and capital flow. You start balkanizing it. So that's why we have proliferation of wealth funds. For example, most of the pension funds, very large ones in Canada, are now trying to highlight more localized investments in Canada rather than sort of yielding you the best possible returns. That's why wealth funds proliferating everywhere globally. In other words, to accumulate the pool of capital within the country rather than relying on what is increasingly unreliable capital flows on a global basis. And so all I'm saying is that this is just the beginning of a process. And so when people ask, is it the peak chaos? The answer is no. We're going to have many peaks as we progress over the next 3 to 4 years, maybe even a decade from now. What the ultimate objective would be is not clear, other than there is a desire to rebalance savings and investments. US since 1980s become the primary consumer. If you go back to 50s and 60s, US was producer, manufacturer. They were saver, they were investor, they were not consumers. Now, the rest of the world took the opposite side. So whether it's Germany, China, Japan, they become savers and therefore pumping their products into the United States. How can you rebalance it? Savings and investment on a global basis. Now, that's by itself could create a challenge. After all, Plaza Accord in 1980s did not succeed. And it did lead to Black Monday, collapse of equities in 1987, and it did lead to collapse of Japan asset bubble in 1990. So all I'm saying is that goods and tariffs is one area, and that area will continue bubbling for a long time. But then we need to look at services, we need to look at capital, we need to look how savings and investments are matched on a global basis. So it's a lot of volatility and change, I think, we're going to see over the next decade.
Fair enough, Viktor. But all of this, back to the same question, all of this means that we are going to be in a higher inflation terrain, and that will mean higher interest rates across the globe?
No, not necessarily. Basically, some countries will have a high inflation, some countries will have stagflation, other countries will have deep disinflation. So, for example, if China cannot export their products, what do?
Right.
They will have to dump it domestically,
Dump it in the
deepening
rest of the world.
disinflation. Well, dump it domestically within China, and therefore
Hmm.
actually deepening disinflation within China, or dumping into other countries. And then other countries will start protecting themselves. So it's not just US putting up barriers. Other countries will be putting up barriers against everybody else. So it's basically everyone on everyone, rather than United States by itself. So in some places, you're going to have stagflation. In some cases, you have persistently high inflation. In other countries, you're going to have deeper disinflation.
Okay, so in the past few years, what has happened? It's, Fed really set the course for interest rates across the globe. So that is one equation that is definitely going to change. Is that correct?
Yeah, it is. Yeah, and that's why, and that's why we're discussing U.S. exceptionalism, because there was a reasons why U.S. was exceptional. There are fundamental reasons. As I said, U.S. Is the only country amongst developed countries that can add labor capital and grow multi-factor productivity all at the same time. U.S. had strong institutional pillars. They had a very deep pool of liquidity. There is no capital control. They were running current account deficits, which would imply that there was a demand for US assets, but also there was supply of US dollar on a global basis. And that is why US was exceptional. And that's why US dollar, as well as Federal Reserve, were setting agenda for the world. Now, that's changing. The question is, it's very easy to say it's changing, but changing where? Because there is no single currency, either physical or digital, that are capable of replacing US dollar today or tomorrow or for many years to come. US dollar is still more than 50% of all commercial transactions globally. They're 57% of foreign exchange reserves. They're over 80% share of foreign exchange trading. They're half of SWIFT transactions. They're 70% of non-resident finances globally. So all I'm saying is that there is nobody. Certainly, euro is not capable of doing it. Yen is not capable of doing it. Yuan is not capable of doing it. So there is nobody else to step into U.S. shoes, and that's why you have to separate the question of exceptionalism from a question of reserve currency status. Reserve currency status will continue, but you will have an elevated level of risk. Now, that elevated level of risk should translate globally into higher risk and higher volatility on a global basis, both in terms of trade, in terms of capital flow, in terms of assessment of weighted average cost of capital. But as I said, it doesn't necessarily mean a uniform higher inflation. It doesn't mean uniformly higher interest rates. All it means higher volatility and a higher risk.
And how do you see the rise of gold in this environment? Obviously, gold has been very, very strong. What's your view?
Gold is the ultimate protection. It's the ultimate insurance policy. If you believe that we might go from a cold wars to hot wars, if you believe that we will be much more aggressively deglobalizing, if you believe the capital flows will be fracturing on a global basis, if you believe that climate change will be far more disruptive than what people assume today. If you believe in pandemics, if you believe in any catastrophic outcomes that potentially could happen globally, gold is your answer. Now, gold is not an investment. It doesn't generate returns. It doesn't even have much usage beyond customer usage. It does not protect you against most conventional things. It even doesn't have relationship anymore to interest rates in any form. It's a pure insurance policies. It can never be a currency. It can never replace US dollar. It can never be medium of exchange, but it does provide insurance. And so when the risks rise, the way we have seen, almost inevitably that leads to a high US dollar. Now, a lot of people suggest maybe digital currencies could be another way of playing it, but the digital currencies really behave much more like equities rather than a protection mechanism.
So far, we've seen the trend of fund flows into Indian equities has been through the emerging market pools. Do you see that equation changing? Is there a possibility that the fund flows into America will now come through India dedicated funds? Overall, because the India story in all of this seems to be slightly better than the overall emerging market pool. Would you agree?
Yeah, I do. Prior to derating of India, sort of from the middle of last year, my view was that India is emerging as an independent asset class. Very similar what happened in Japan in early years. And then Japan, everybody forgot about Japan for 25 years. And then gradually over the last 5 years, Japan was emerging as an independent asset class. I think the same happening in India. So instead of treating it as part of EM universe, more and more funds will be looking at India separate. From the EM universe, either through dedicated India funds or through the global funds or through industry specific funds. And therefore, there will be more research done on India. There will be more trips to India to look at whether it's in a fixed income market, whether it's an equity market. In other words, to do more detailed analysis rather than just treating India as part of the allocation in emerging market universe, which with the way people traditionally looked at India. So in the past, international investors never really have gone beyond some of the larger Indian companies, for example. I think today that is not true anymore, and I think that will become even less true as we go forward. So India has a capacity to emerge as an independent asset class. Now, why is that? Again, compared to the United States, just like US, India is aiding labor, capital, and growing multi-factor productivity. Europe cannot do it. UK cannot do it. Canada cannot do it. China cannot do it. Japan cannot do it. But US and India can. Now, that gives you a very strong structural backbone. The other thing, geopolitical position. I describe India as too big to be small, too small to be big. It's too big to belong in any grouping, but it's too small to sort of punch its own way. And so it's in a perfect geopolitical position of benefiting from whatever geopolitical shifts are likely to happen on a global basis. You're also seeing India continuously investing capital quite efficiently. Now, we can debate whether 10 years from now that will be true, but India is still short of capital in a meaningful way. That's why incremental capital output ratios in India are good. That's why overall leverage of India economy is not increasing, and that's why Indian corporate return on equities are one of the highest on a global basis. So you can see how the same as in the US, there is a structural strengths. What are the weaknesses? Just like in the US, it's social and institutional. So if you think of the United States, it's got a structurally sound economy, but massive institutional challenges. If you think of Europe, it is not, doesn't have really institutional or political challenges much, but it could structurally have massive problems to overcome. If you think of China, again, institutionally, socially, they are okay, but massive structural problems because China has found itself in a liquidity trap. India is a little bit like US, structural economy, but the problem is social and institutional. And how you resolve those social and institutional problems could create a problem for India as you go forward. But so long as those are kept under control, structural forces will continue to drive India at least for the next 5 to 10 years. And that's exactly why investors are starting to look and have been for the last several years, at least, starting to look at India separately from just being an emerging market allocation. And I think that will continue to, that way of looking at India will continue to increase.
Viktor, a couple of more questions. First of all, your thoughts on China equities. Last year, we saw some kind of a tactical trade playing out there in the backdrop on expectations of China stimulus. How do you see that going? Is that a trade that is now set aside in the wake of the conversations between US and China and the standoff, or do you see some scope for that to happen yet? And secondly, what is your take on US equities, particularly tech, the Magnificent Seven?
Well, in the case of China, as I said, structurally, there are major challenges, not dissimilar to Japan of 1990s. and that is, yeah, China maintained national saving rates at 45% for too long, well over 2 decades. And so the result is China massively overcapitalized its economy. To give you an example, if you think of fully depreciated assets, that is your gross fixed capital formation minus depreciation. If you go back to '05, India had about $1 trillion. China had 4 trillion. Today, China is over 100 trillion, and India is closer to 8 trillion. It just shows you how much more capital flown into China. Whenever you flow so much capital so quickly, you inevitably misallocate capital. You usually find it in real estate, you find it in infrastructure, you find it in financial speculation, and in China, you got it all in all three areas. And so the question is, having overcapitalized, do you see the symptoms of a liquidity trap, whereby it's not about the demand, it's not about supply of money or credit, it's about demand for money. There is no demand. And so, can you see the evidence of that? Well, the answer is yes. Whether you look at explosion of leverage, whether you see explosion of banking assets, whether you see massive rise in incremental capital output ratios, whether you see in rapid decline in corporate return on equity, it's all in there. And so China is facing a very difficult process. How do you extract yourself from that liquidity trap? Do you follow the Japan example, or do you try to do something much more dramatic? So it's not about stimuli. In fact, the more China's conventionally stimulated, the worse its long-term position is going to be. And that is why China is very restrained what they do. But on the other hand, restructuring the economy will be hard because you need to lower national saving rates. In order to do that, you need to relocate the money from central government to provincial government. You need to massively strengthen social security net. You need to substantially increase productivity in agriculture. There is a whole range of things you need to do, which are very hard and will decrease the power of the state and control that the state has over the economy. Effectively, you need to delegate it to the provinces, to local authorities, to consumers and to businesses, and that's China is reluctant to do. So longer term, you have a challenge, but in the shorter term, if you say the degree of volatility that that US has experienced, US is currently trading inflation-adjusted equity risk premium of about 3.5%. China is more like 7.5%. So is there a difference between the two that big? And so what investors have been concluding that the difference should be narrowed. Nobody is really embracing long-term growth of China. Everybody is concerned that disinflation could stay and maybe even get deeper. There will be slower nominal GDP growth rates than real GDP growth rates. So nobody is actually buying the long-term structural story, and everybody concerned how China will address its structural problems. But what you're seeing is narrowing of perception of differences between China and the United States. And therefore, I've always classified China as as a story that can trade up very aggressively, but longer term facing significant structural headwinds. And in fact, what we're seeing now is actually a number 5 trade off in the last sort of 4 or 5 years. So it happens reasonably often, and it's quite strong, but it has a problem sustaining it over the longer term. Now, TAC in the US, I don't like talking about TAC because everything these days is TAC. So when people say, what about Magnificent Seven? Well, Magnificent Seven doesn't exist anymore. So everything is about TAC. So one of the key pluses of the US, and one of the things I am concerned about what Trump administration is doing is the inventiveness of the United States, an ability to progress from inventiveness to innovation. And there is no other country in the world capable of doing what US is doing. But by cutting supply of funds to universities and colleges and research programs, because remember, US government in the past funded more than half of all fundamental research going on in the United States. You're starting to cut off that benefit that you have. And the other thing you're cutting off by trying to rebuild the world it's going to be tougher for technology companies from the United States to get the full leverage of those products. So US is an amazing place, both in terms of inventiveness and innovation. There is no other country in the world capable of it. It's just a question whether the policies of rebuilding the world could actually make them less attractive as you go forward.
Viktor, this is truly the last question. So a few days ago, we had a terror strike in India. What is your view? How are foreign investors viewing the political situation here? Do you even see that as a risk?
Well, I see more of a risk, the unbalanced economy of India. If multi-million-dollar apartments in Mumbai go in minutes and there is no plumbing next door, you have a problem. If you have such a massive disparity between rural and urban areas, you have a problem. If there is, and nobody knows how many people, but if there are 600-700 million people who are involved in agriculture at a very low level of productivity, and most of them are illiterate and not prepared for anything else, you have a problem. Clearly, you also have a problem between different racial, ethnic, cultural groups as well. So to me, it's a mix of all of those things. Remember, I said about the United States, there is a massive polarization in the United States, geographically, by culture groups, by where people live, what they do. In a way, you have it similar in India. And as we saw in the United States, it could lead to pretty dramatic outcomes unless those problems are rectified in some form. Now, does that involve higher social spending, for example, to bridge some of those gaps? Does that involve agricultural reform and then providing educational and skilling opportunities to many people who might be displaced from agricultural areas? Do you need to think of monsoon seasons becoming more erratic, and therefore how you get water, deliver water, what plants do you plant, how do you harvest, who do you deliver the products to, what prices you pay? I mean, all of these areas are important. It's what I call domestic economy. Most emerging markets manage to create quite competitive export-oriented niches. But domestic economy where they struggle, because that's where politics is, that's where corruption and nepotism is. And to address those issues, and usually domestic economy are things like retail trade, wholesale trade, utilities, construction, agriculture, usage of land, usage of labor. In every emerging markets, it is a problem. And that's why domestic productivity is so low. If India wants to get to 8% growth rates, either public sector has to spend a lot more than what public sector is spending, because private sector in India predominantly saves, not spend. So either you have to do that, or you have to significantly raise domestic non-tradable productivity, which currently is only 10 to 15%, for example, of the US level. But that creates its own problem. As I said, what do you deal with? What do you do with retail trade? What do you do with hundreds of millions of people involved in agriculture, for example? Or the third area you have to increase even more efficiency of capital utilization. So if you want 8%, these are the three things that needs to be addressed. Otherwise, India will be at a lower trajectory as you go forward. And if you stay at a lower trajectory, you create less middle class, essentially. And if you create less middle class, you increasingly polarize society on regional lines, on national lines, religious lines, city versus country, etc. And I think that's what you saw in the United States, and that was a reason, and there is a reason for polarization that occurred in the United States, and that's what you're seeing in India as well. And that's why I bracket India and the United States in the same category. Structurally sound, could deliver substantially faster growth rates that almost anybody in either emerging market or developed market universe, but facing significant social and institutional challenges.
Thank you so much, Viktor, for your time today. It was an absolute delight talking to you. Thank you so much for watching us. Stay tuned to Money Control for more news, views, and updates on markets.